Welcome to Her Money Revolution. I'm your host, Angela Brooks, your guide on this journey to becoming a wealthy woman. As a certified financial planner, owner, and advisor at Family Capital Management, I'm on a mission to simplify the conversation around investing and to help women generate more wealth by making their money work for them. Join me as we navigate powerful financial planning strategies to help you achieve your personal and professional goals. This podcast is your go-to destination for no fluff, easy to implement financial and investing advice. If you are ready to achieve audacious financial goals, dream beyond boundaries, and generate massive wealth for you and your family, this podcast is for you. Grab a notebook. Let's get started. Hello, and welcome back to Her Money Revolution, the podcast where we empower women to grow their wealth by making their money work for them. I'm your host, Angela Brooks, and today we're continuing our Investing Toolkit series with a powerful tool for evaluating growth stocks, and that's the PEG ratio. So if you've ever heard of the price to earnings ratio or the PE ratio and wondered if there's a better way to assess a company's value, well, I'm here to tell you, yes, there is. It's called the PEG ratio, and it helps you see if a stock is fairly priced based on its growth potential. Grab a pen, grab a notebook. This one's going to get a little bit technical, so get prepared. Let's break it down. First, what is the PEG ratio? Well, it stands for price to earnings to growth. So it builds on the PE ratio by adding the company's expected growth rate into the equation. So the formula looks like PEG ratio equals the PE ratio divided by the annual earnings growth rate. For example, if a stock has a PE ratio of 20 and an expected earnings growth rate of 10%, the PEG ratio is 2. So what does the number actually mean? A PEG ratio of 1 is considered fairly valued. It means the stock's price matches its growth expectations. So the PEG ratio below 1 suggests that the stock may be undervalued and could be a bargain. A PEG ratio above 1 may indicate that the stock is overpriced for its growth potential. Now, why is the PEG ratio so useful? Well, the PE ratio alone only tells you how expensive a stock is relative to its earnings, but it misses the bigger picture. It misses the growth. So a high PE ratio isn't always bad if the company has strong growth potential. The PEG ratio helps you see the full story by factoring in that growth. So let's walk through an example, and I'll try to do this a little bit slow so you can lock it into your memory here. So suppose you're comparing two growth stocks. Stock A has a PE ratio of 30, but it's expected to grow earnings by 25% annually. So its PEG ratio is 1.2. Okay. Stock B has a PE ratio of 15, but only a 5% earnings growth. So its PEG ratio is 3. Which stock do you think is better? Even though stock B has a lower PE, stock A may be the better buy because its PEG ratio shows it offers more growth for the price. Okay? So having the PEG ratio and understanding how that works is really, really going to be beneficial for you if you're picking your own growth stocks. Again, with any tool, any factor that you're looking at, any data point that you're using when deciding, should I buy this? Should I sell this? Should I hold this? Just like that, the PEG ratio has its limitations. Okay, so it relies on projected earnings growth, which can be uncertain. One could project, nobody can tell the future. Maybe some people can. I can't. Most people can't. So it is uncertain. And it works best for growth stocks. I know I keep saying growth stocks, but I only focus on growth stocks, especially in sectors like technology or healthcare. So how should you use the PEG ratio in your investment strategy? Well, first you want to use it to compare companies within the same industry. Okay. Growth expectations vary across sectors. So you don't want to look at a health stock and compare it to a technology stock. You want to look at something in the same industry. Second, don't rely on it alone. Again, combine it with other metrics like return on equity and free cash flow. Other data points are going to be really useful to help you make that decision if it should be in your investment portfolio or not. And then third, you want to be cautious with extremely low PEG ratios. Sometimes they signal trouble rather than opportunity. So here's my advice. If you're looking at growth stocks, the PEG ratio is a must-use tool. It gives you the fuller picture than the PE ratio alone. But always look beyond the numbers, understand the company's business model, understand the leadership strategy and market potential. Don't ignore all of those other things, right? So to sum it up, the PEG ratio is a smarter way to evaluate growth stocks because it balances price with potential. It's most powerful when used alongside other metrics and with a clear understanding of a company's growth story. This was a quick one. That's all I have for today and Her Money Revolution. If you found this helpful, share it with a friend, like it, subscribe so you never miss an episode. Understanding how to evaluate growth stocks can help you make smarter investment decisions and build the wealth that you deserve. Until next time, believe in your power to build wealth and bless others with your knowledge. See you soon. Thank you for joining me today, and I hope you are feeling more empowered in your financial journey. Remember, follow and subscribe to Her Money Revolution on your favorite podcast platform and share your feedback by leaving a review. I'd love to hear your biggest takeaway from today's episode. Until next time, stay inspired.